You just got back from a couple trips. The first one was on the Tejon area in California, in New York City. Why don't you tell us a little bit about that and how that relates to some of our portfolio companies that we own today?
Yeah, so the Tejon Ranch Company, they're somewhat similar to a holding that we have in Five Point Holdings. It's located in California. Um, this property is located about 40 miles north of Valencia, which is where Five Point is. And it in the Tejon Ranch basically sits between the center of like northern and southern California. It's a major logistical route just south of Bakersfield, California. The main difference between Tejon and Five Point is Five Point is a land development company that primarily serves the single family market. So they flatten the land and then they sell it to Lennar, D.R. Horton, and then they build single family homes. Whereas the Tejon Ranch, they have other commercial real estate properties or businesses that generate revenue today. So one example is they own a piece of farmland that grows pistachios, and the growing of pistachios they sell to markets, grocery stores, whoever needs pistachios, and that's a source of revenue generation. Their main property is called the Tejon Ranch Commerce Center. They call it the TRCC. It's a retail and service area. Again, it mainly acts as a gas station service area where people traveling or commercial vehicles traveling between northern and southern California stop, get gas, get lunch, whatever it is. They have other ancillary properties. They have a master plan community segment that they have spent several $100 million developing, getting entitlements for, but has not started construction at all. So it's basically just been a money suck thus far. And so the real reason I went down to New York to listen to the company was, one, to get a perspective of what's going on in California, how it may relate to Five Point, and then two, maybe I came away saying Five Point's a great company, but the assets that Tejon owns are more undervalued, and instead of owning a company that is more of a buyer and seller of land, maybe we should own a company that develops and continues to have an ownership stake in the properties that they develop. The really interesting part about going there was it sounded so similar to Five Point in that the investors there have done very poorly. The stock has gone nowhere since it's come public. Many of the investors there have been long-term shareholders, so they have lost money or not made any money during this bull market. And the CEO took over, I believe, about 9 months ago, and it was the first real public appearance anybody has ever made from the company. They just hosted their first ever earnings call a few weeks prior to this, and now they're on the road presenting their story to investors. So this was the first time the company had really started making an effort to get their story out there. And unfortunately, when you have decades of stock price underperformance, the investors in the room are not the most excited or happy individuals to see these people. They're obviously happy that you're out on the road trying to tell your story, but they've also lost money in the investment. So the CEO, to his credit, took about 2 hours of like Q&A presentations and basically tried to outline, hey, this is where we went wrong in the past. This is what's going to be different in the future. The company went through a proxy battle last year and spent a couple $1 million on it. And there were some investors that were not happy that they went through it, especially when the company already doesn't make money. Now you're throwing additional capital towards an effort that in the end was not worth it. So I think one of the things that was interesting was there was a larger shareholder or a very informed shareholder that sat in front of me, and it was interesting to hear what he thought. I talked with him in the beginning about what his plan and his vision was of the company. He wants them to divest some of the properties that they own because the stock trades at a significant discount to its book value. So if you can sell some of your properties for book value or more than book value and use that capital to maybe buy back stock or reinvest it into areas that actually meet certain return thresholds, that would be a great scenario. It was then interesting to listen to what the CEO's plan was and watch this investor's reaction. And almost every time the CEO spoke, the reaction was not a pleasant one. So my perception coming out of that investor day is that what the CEO said and what investors wanted to hear are still not in alignment. And the trouble is when you're in an idea for 10 years and it's gone nowhere, like there is like such a reluctance and a bias that they just want the stock to work because they feel that they're so invested. My sense was that more people came away dissatisfied with the future of the business than I think what the management team was hoping. So all in, the one thing that I talked with the CEO about is just like what's going on the like the government side and the entitlement side. Is it getting harder, easier, the same to entitle land in California? And he told me that it's the same, getting slightly better to get land entitled, which would be a net positive for Valencia and other properties that 5 Point owns. So I think all in, my takeaway is we probably have the better management team. We as in 5 Point. 5 Point owns Great Park. That's a much better location. The Tejon Ranch is their pitch was we're 40 miles away from Valencia, but you're going to pay a significantly lower price to purchase a home. When they start developing this master plan community, the issue is like there is nothing around it, and you're not going to drive 75 miles one way if you work in downtown LA. That's probably a minimum hour and a half, 2 hour commute. And so realistically, it's probably only ever going to be a logistics hub. I would expect warehouses, more travel center expansion. But in terms of building out a full-fledged community, that seems like a tall order, unless you're going to look for maybe retirement. I'll say like retirement communities where people don't have to commute to LA on a daily basis or weekly basis, and they're just looking to find a cheaper home, still want to be in California, and maybe they have proximity to family members should they ever want to go visit them in other parts of California. So in the end, it was interesting to hear. I think the other takeaway is just as we found out with 5 Point, things tend to take longer than you can ever imagine. I think many investors there thought the master plan communities would have already had homes built, commercial properties built, and they have yet to put a shovel in the ground yet. And so that's exactly what we saw with 5 Point, and sort of just reiterates that things often take longer than you initially think.
Well said. Yeah, is that one that you think you may keep an eye on in the coming years?
I think we will, just because if for some reason like Tejon starts to sell land in their master plan communities and they start seeing the price of an acre decline, it would likely flow through and affect Valencia as well. So I'm going to follow it mainly because I want to see in the future what the cost of an acre in Tejon is versus what a cost of an acre is in Valencia. Because at some point, maybe that 40-mile drive, if it's $40,000 that you're saving, maybe that's not worth it. But if you're saving several $100,000 because the cost of the land at Tejon versus Valencia is that much cheaper, maybe then people start to migrate out even further from LA. For now, it's not a name we would purchase just because I don't get the sense that we are at some sort of profit or build out inflection that is going to materially change the story in the next couple of years.
Well said. You also recently went on another research trip, Three-Part Advisors in Dallas. Why don't you tell us a little bit about that as well?
Yeah. So this was a 2-day conference, and one of my focuses for the end of this year and into next year is I'd like to meet with more management teams. A lot of the times the presentations that they have are just more high level and not into the weeds of a business. And it's relatively easy to understand the high level parts of the business, but it's typically the key, we call them the KPIs, the key performance indicators of the company that we want to discuss in more detail. And so some of the companies I met with are US Physical Therapy. They're basically a nationwide physical therapy center. They have hundreds of offices. Main reason to meet with them is we don't have a lot of exposure in like the healthcare area. So maybe they would be an interesting play. They have some AI initiatives, which may sound crazy, but when you go and see a PT, if instead of the PT having to write down everything and sort of remember what the patient said while they're meeting them, if you could have basically AI listen to you, fill out the sheet of paper, that then eliminates some like back office work, and now the physical therapist can see more clients in a day. So maybe the number of clients a PT can have is higher. So that was interesting. Green Brick Partners is a home developer in primarily the Dallas-Fort Worth area, and they also have home sites in Atlanta, Georgia. We obviously have a decent presence in the home building industry, whether it's through the lumber warehouser, Green First, or 5 Point, Tri Point Homes. So I wanted to hear just what their assessment of the real estate market was. Everything I read right now is that the real estate market is very slow. The number of new orders is declining. And so we're getting to a point where home builders are finishing more homes than they are signing new orders. And so as you work down through the backlog, does that present an issue on basically like the revenue and profit line? Because you have a static workforce, but less homes that they're building. And so that would be a margin issue. The Dallas, Austin, Texas market are relatively oversupplied right now. And their opinion was Q4, you're going to start seeing some heavily discounted homes. So these home builders can get maybe these homes that have been sitting idle for 6-9 months off the books and sold. It sounds like people are just praying for lower interest rates at this point. Their thought was a 5% 30-year mortgage is sort of like the sweet spot of they'll start seeing a significant acceleration in home purchases, because when you get to a 5% mortgage, the home builder now doesn't have to incentivize home buyers by paying down their mortgage rate. They can maybe lower the price of the home itself. And so that way they'll still maintain the margin because they're not buying down the mortgage rate. But you'll get more homes ordered. So I think the takeaway from them was the housing market is very challenged right now. I can keep going on different companies, or if you have any follow-up questions.
Yeah, why don't you tell us a little bit about your thoughts on the 5% interest rate target Do you think that's something that we may see in the next few years, or do you think that's just kind of a little bit too optimistic?
Yeah, when I talked to them, they were saying, oh, in December, I think it's now down to a 50-50 chance that interest rates, that the Fed cuts interest rates. And I'm going to say maybe a month ago, it was close to like a 95% chance. And I asked them what their thoughts are on if we cut interest rates, since the Fed can only control the short rate, what happens if the long rate actually goes up? And that is my concern right now is, are we cutting into an inflationary-ish environment? And do interest rate cuts, people think interest rates are going to automatically come down. What if the opposite happens? Do you see even less home purchase activity? Maybe you get some stimulus on the repair and remodel because anybody with like a home equity line of credit, that interest rate is lower for the time being. But that does not matter for people that are buying a new home. I I am skeptical that we are going to get on our own to a 5% interest rate in the next at least year or two. I think the AI data center build out is holding up the US economy, and all the outside investment is holding up the economy. And if it weren't for that, maybe a 5% mortgage is more in the cards. The other thing is like typically I think it's typically like 150 basis point spread over the 10-year treasury is 10-year or 30-year treasury is where a 30-year mortgage typically is priced. I think today we're closer to like 250 basis points, and that's due to the amount of volatility we've seen in interest rates. And so if you get more of a constant interest rate or lower volatility interest rate environment, does that spread of 250 collapse to 150 basis points? And that's a natural 100 basis point decrease in mortgage rates. You still then need another 100 basis points lower in the 30-year interest rate.
There's also been some discussion about a 50-year mortgage potentially coming. Do you think that's something that we may see? What are your thoughts on that, given our allocation to the real estate industry?
Yeah. The math, from what I understand, is people are having just as much trouble coming up with that 20% down deposit as they are qualifying for a loan, or meeting like the requirements at certain interest rates for the loan. If you like run the math on the difference between a 30-year interest or a 30-year loan and a 50-year, it really doesn't save you that much money. I don't think that's gonna change anything really.
Right.
I think if anything, that would more likely in the long run exacerbate people's uh unwillingness to move from homes. You can imagine I have a 3 1/3 30-year mortgage. If I have a 50-year 3 1/3 mortgage, like I'm already unlikely to move. You give me another 20 years of basically close to 0% interest, I'm probably even more reluctant to move.
Yeah.
Now, that also requires low interest rates, but I think at some point something like that would happen. I think um, it's a short-term solution that is probably going to have long-term negative consequences.
Any other companies that you met with that stood out that you want to hit on?
Sure. One of the ones that was interesting, similar on the real estate side, is Franklin BSP. They originate commercial loans for primarily apartments. They're located in the Sun Belt region, so I believe it's like North Carolina, Florida, Texas, just like that coast. And what's interesting and what's been happening in the commercial real estate industry is we've seen interest rates increase, and property values are tied to interest rates. So the higher interest rates are, it's called a cap rate, just the multiple people are willing to pay for an apartment complex is going to be lower if interest rates are higher. They're going to be the multiple you're willing to pay is going to be higher if interest rates are lower. Typically just a spread based on like a 10-year treasury rate or a 30-year treasury rate. And Franklin typically writes either construction loans, bridge loans to these commercial developers. And then the plan is after a couple of years, the property gets stabilized. The apartment owner goes out to it's going to typically like a life insurance company, Fannie Mae, Freddie Mac, and refinances that loan to a stabilized 10-year, maybe 30-year commercial loan. What's happened at Franklin is because interest rates have risen so quickly over the last couple of years, many of the property owners that have loans with Franklin, these 3-year loans, are struggling to refinance into that permanent loan, that 10-year, 30-year loan. And it's a function of they got these interest rates when SOFR was maybe 1%, 2%. And so their all-in rate might be 5.5%, 6%. But when they go out to the market today, maybe that is closer to 6.5%, 7% rate. They're probably a little lower than that, but directionally going to be correct. And either the properties are not leased up to the rate that these owners thought it would be. So maybe they thought by the end of year 3, these apartment complexes would be 95% leased. And based on their projections, that would equate to $1 million in income. But today they stand and the apartment may only be 80% leased. And the difference between 80% lease and 95% leased, that incremental 15% lease up is all profit and makes a significant difference on the profitability of these properties. And so the properties might be underperforming a little, interest rates are higher. One of these on their own may not be an issue, but when you combine them, it results in, hey, these loans are underperforming what they were underwritten to be. And so now they said that these loans, and the real issue is around 40% of their book is roughly these loans. It's assets that should have been, or loans that should have been refinanced already. It's assets that are maybe underperforming what they were underwritten to be. Some sort of combination of 40% of their loan book is not where it's supposed to be based on their projections. And they've already extended many of these loans for a year with basically the hope that interest rates come down and they are then able to go out and refinance these loans at a rate that they're able to afford. And I got the sense that there is so much hope that interest rates are going to come down and are going to bail out a lot of these developers in maybe properties that they shouldn't have developed, or just maybe they made some aggressive assumptions on their underwriting. So the market today is pricing Franklin's stock at about 70% of book value, which means, if the market thought these were high quality loans, no issues, they would probably trade at book value. So 1 times book value. Today the stock trades at 70% of book value, 0.7 times book value. So the market is saying, hey, we understand there is some credit risk associated with you. They also have a 14% dividend. Like a 14% dividend does not happen unless there are serious concerns about their ability to continue the current dividend rate. Right now, their free cash, their income does not cover their quarterly dividend payment. They just made an acquisition. They have a couple other ongoing initiatives where they believe in about a year, they will go from not being able to cover the dividend to covering the dividend with income generated. It's a hairy situation. It feels similar to the private credit market where nobody wants to take a bad mark on their portfolio, because if they take a bad mark, then everybody else is going to have to start taking a bad mark, and it kind of cascades on itself. Obviously, a 14% dividend, if they can maintain it and get themselves out of the current situation they're in, it'd be a very attractive investment. It's one that is going to be on the watch list. I have some background on the commercial real estate side. it's going to take some significant due diligence of going not a property by property basis, but looking at a relatively granular level at what properties are currently in the like negative equity value situation in that 40% bucket, and what's like the possibility that they actually can go out and refinance their loans. They've taken some properties already and sold them. Their typical strategy is if somebody throws the keys, they'll take a quarter or two to try and lease up the property. That way, it's a stabilized property. That's typically easier to sell to a REIT or some other buyer versus, hey, I have an 80% occupied property. That's a little tougher to sell. So all in, a little more worried about the commercial real estate loan market than what I thought was going on.
It's good to know. Yeah, I appreciate your insight, and I speaking personally, I always appreciate when you and Peter go and you do the research, because it always gives me some peace of mind that we know these companies very well that that I own. So I appreciate that, Dom, and thanks for your time today as well.
Absolutely. Thanks, Kellan.
Sure. All right, we're done.